Dale, good morning. Welcome to Face. And I know I'm not Dale Pinkert, but I'm Blake. Nice to meet you.
Good morning, Blake. Good morning, guys. How are you?
Good morning.
And I'm not a novice. I was on 3 months ago, so
Okay. You know what? I've for some reason I was thinking this is your very first time. My mistake. Good to see you. And I know I've been following you probably for like the last year. And tell us a little bit about yourself and about your experiences in the markets because you have quite a past.
I do. And if it suits you all, I'm going to share my screen if that's okay.
Absolutely. So here you go.
Okay, are we sharing now?
I'll let you know when I see it. I do not see your screen yet.
Me neither. Hello, Dale.
Hey, Stel, how you going?
Very good, thanks.
Uh, okay,
Yeah, I still
there
don't
we
see your
go.
screen
Okay,
just yet.
yep, here we go.
Yes, now I can see,
We have
yes, your
it.
presentation.
Yep, cool.
You know what, Dale? It's my bad. I do actually now my memory's coming back. I do remember having you on here and I sat through because it was your first time. So welcome back. My
Uh,
bad.
Thanks, Blake. And you're not alone. I'm getting to the age now where I can't even remember what I've had for breakfast in the morning. So it is that time of life. Anyway, I know that you guys are probably pushed, and there's sort of a window of opportunity here. So why don't I just crack on with what I put together for you?
Please do.
Okay, so a little bit of background about me very quickly. I've got a master's in engineering from Imperial, which Stel will know. It's the UK equivalent of MIT.
I went to Imperial as well, by the way.
Yes, I know you did.
Yes, yes.
I'm a few years older than you, though, and I've been around the business a long time. I've worked for various of the great and the good, primarily as a prop trader. I've run various hedge funds. I've allocated to hedge funds as well. Sat on the boards of a number of different funds and firms. I've traded pretty much everything during my career: equities, fixed income, currencies, commodities, and have been trading derivatives since 1987. So I have quite a background in terms of markets. I'm now actually semi-retired and have been for a few years. But I still advise a handful of the world's biggest hedge funds and asset managers on global macro and long short equity portfolios, and been consistently ranked #1 in the world for what I do. So hopefully I can share some of those insights with you today. I use what I call a techno-quantum mental investment process, and I think it's really important that everybody understands what their own investment process is. So first of all, I start out with a global macro view of the world in terms of a big picture view on growth, inflation, rates, what the central banks are doing, and don't get me started on central banks. That's my key bailiwick. And then I apply various proprietary screens and come up with some themes or thematic ideas about the world and what I want to look at. And then once I've screened the universes of assets that I want to look at, I then look at technical analysis, which is why I like listening to what you guys do, and you do a great job. So uh, here's my track record or my credentials, if you like. I typically aim to for the hedge funds that I work with, I typically aim to make about 10% a quarter in terms of alpha. And that's what we call dollar neutral, or you extract all the market risk out of your portfolios. I do also run a very, very strict market neutral book for one of the biggest hedge funds, where there's literally only stock specific risk in the portfolio. But this is the track record for the opportunistic long short, which I run for a number of hedge funds. And there you can see sort of P&Ls that we run in terms of that's one of the portfolios. So I guess one of the reasons why I got invited on is I'm sort of fairly well known in the community for my macro calls. And Stel will probably remember this. Back in 2020, I called the low on interest rates as well as the low on stocks at the time. And I said then, and I've said for the last 4 years as well, we are now in a generational bull market for inflation and for yields. And although we may get pullbacks along the way, the trend of least resistance is upwards. And I do believe that that's going to take place over the next decade plus. So I don't think in my lifetime, I don't want to do a Janet Yellen, but I don't think in my lifetime we're going to see rates as low as we have, back in 2021. So here's a couple of the ideas that I think we talked about last time I was on. This is going back to November of last year. We were looking at silver, and we basically said we think it's going to be going much higher during 2024, and obviously that's played out quite nicely. I still don't think we're finished. I think we still have higher to go. In fact, we could have a lot higher to go. This is something else that we were looking at the time, which is the ratio of small mining companies to large mining companies. And generally speaking, when small miners are outperforming big miners, it's generally a bullish environment overall for mining stocks and for metals. So that was something that we were looking at the time, and just to reinforce our conviction. And by and large, we tend to look for lots of different things pointing all in the same direction before we jump onto ideas or trades. And here's another example of that. We looked at, the gold-silver ratio chart, which I guess other people look at as well. But when this is breaking down or going lower, it means that silver's outperforming, which again is another pointer to a good environment or a bullish environment for metals, and therefore also mining stocks as well. We've also been on the copper trade, for the last couple of months. I did tweet about this while I was having a little holiday a couple of weeks ago, because I was on vacation. I actually got out too early. We rode it up from $4 to about 470 in the space of about 6 weeks, and I think Stel saw me tweet about it on X. I was actually on vacation at the time, and I thought, we made a good amount of money, and I just want to enjoy my vacation. So we actually got out too early, but we have been on the bullish side for most of the metals and mining companies. Here's an idea that we put out at the end of Q1, which is short cocoa, and it's the same for everything in financial markets. When you get parabolic charts, doesn't matter what it's in, but you see it more often in commodities and I guess meme stocks as well. When you get parabolic rises, it inevitably ends in failure. It's just a question of timing. And with this short cocoa trade, I think I said at the time, you have to have deep pockets. You have to have it as part of a portfolio, as a small position size, because I think a lot of younger or inexperienced traders try to do is they try and swing for the fences, and they put position sizes on too big without realizing that things can go against you, and what you don't want to do is get yourself stopped out of a trade. I mean,
Dale, can I interrupt you here? And
Yeah.
you said something really particular, which I 100% agree. I mean, not knowing exactly, I could barely even read exactly where it went, but cocoa, it may have gone maybe another 10 or 20% higher, but it's obviously reversed quite aggressively since then.
Yeah.
And you said that a lot of these types of moves, which I 100% agree, happen in commodities, but we're in a different regime now than we were 10, 20, even 30 years ago. And do you think the same rules still apply in the commodities market, or are we going to have a prolonged commodities rally moving forward? What are your thoughts there?
That's a great question. I'm going to come on to that, and
Okay.
I'm in the latter camp. Because of my core belief that we're in a generational bull market for inflation, I do think most of the ideas that we're working with right now in the portfolios are long inflation trades, which by definition means long commodity type trades as well.
All right, very good. By the way, Stelios had to bow out. He wanted to say goodbye, but didn't
Yeah,
want to interrupt you. So
no worries. I'll catch up with him. Here's another trade that we've been on the last couple of months. My nickname, by the way, is DB Noble for two reasons. Number one is I don't take any BS, and number two is I make quite a lot of money over the years from being short. So I'm a short seller by nature. It has a tendency to I guess to arise from the fact that I started out life in the markets in the 80s, and one of the first big experiences I had in 87 was the stock market crash where we lost 20% in a day. So you tend to develop your market trading skills from the environment that you're in when you're first starting out in the business. So
Dale, I hate to interrupt you, but it's funny. I was just having a conversation with Jared Dillian, who's the editor at the Daily Dirt Nap, just last week. He was saying something similar on Real Vision, and I am a product of the .com bubble and blow up. So I 100% agree. You're a product of what environment you were brought up in. You were brought up in the late 80s through a crash. I was brought up in the .com bubble. So through a crash really is when, I matured more into my late 20s. But I always, since I made so much money on the short side, I tend to lean that way too. And Jared was saying he did the same thing because of the .com bubble. So that statement rings true with myself. Which will also be really interesting. 2 generations from now, or a full generation of traders from now, are going to always lean probably to the bullish side. And ironically, we might be in a market that's in more of a consolidation.
I agree 100% with that comment.
Yeah. Okay. Anyway, I just thought
yeah, yeah. So the point about this slide that I was trying to make was, historically I've made a lot of money on the short side, but in recent times I've been bullish pretty much everything because of the environment that we're in. So so we were long DAX, we're still long a little bit. We took half of it off. And I've been one of the most vocal people speaking out about cryptocurrencies. I can't profess I understand them or understand the use case for them. They're just another risk asset as far as I'm concerned. And to that extent, you need to be trading things like they are an inflation hedge. And so, we've also been long of Bitcoin in recent weeks, and that's gone pretty well. So we're looking at, potential drivers going forwards for markets. What are the thematic drivers? And as I think you've already said, Blake, what are the views on commodities? And the view is, given what the Fed has done over the last 2 decades, and if you follow me on Twitter, you'll know my beef about the Fed and what they've done. We have an excess of capital in the system, and it's manifesting itself in all sorts of ways. The politicians and the economists can talk as much as they want about, things are slowing down, inflation's coming down. It's absolutely hogwash. So our view is that things are destined to go higher. Commodities such as uranium, we've looked at and we've had investments in. Silver, we've been in the precious metals. I think silver's going higher, potentially much higher. Even the soft commodities are following suit now. You're getting sort of wheat and corn sort of looking like they want to go higher. The thing that I guess a couple of points I'd make is I'm a little bit confused at the moment. I've been a big believer in higher rates, and I still think that's the case much longer term, and probably a stronger dollar as well, because obviously higher rates drives the dollar on a relative basis anyway. But a couple of things are perplexing me. One is we may have had a failed breakout of the US-German yield spread, so that potentially is suggesting a weaker dollar, although I still can't get my head around that right now. And if that is the case, if it is failed, it has huge implications for asset markets, yields, currencies, equities. It has major implications. And I still think we're on the fence with that right now. We have to sort of wait and see for, a few weeks, maybe a couple of months to see how that pans out. And the other thing is I've been looking at the yield curve in the US. I do believe that we're going to get a curve disinversion, meaning that short rates are going to come down and the curve is going to flatten and go flat.
That's usually a precursor to
Yes,
a recession, or like
yes,
right on the cusp of one, right?
yes,
Yeah.
exactly. And historically, that's been a bad omen for stocks. It's not happened yet, so I'm still playing a waiting game on that. And I think those two things with the yield curve, we need to keep watch on quite carefully.
Yeah.
Um, but failing that, I think the building blocks are in place still for risk appetite to be in markets, and I think you pointed that out already. There is still no clear sign that we're getting a breakdown in risk assets, as the growth of the value ratio suggests. So, coming back to my pet chart, going back 50, 60 years of inflation, I've said this for a long time now. Once you let the cat out of the bag, you cannot get it back in. And the Fed have manipulated interest rate markets for so long that eventually you had to start showing up somewhere. And that manifested itself post 2020 with inflation. I think inflation
Oh,
is
I was gonna just I want to ask a question here because I'm with you on this, but like you're seeing, and I'm just speaking directly to the U.S. What we're seeing here, you got companies like Target and McDonald's specifically just over the last week, they've talked about they're going to be dropping their prices. Do you think disinflation or even a deflationary spell is even possible? Because I'm with you on what you're seeing here and what you're showing here. I just wonder if demand falls off the cliff because of high prices, we could actually get into a deflationary type of environment. But love to hear your thoughts here.
I don't think we're going to get deflation.
Okay.
If anything, I think we're more likely to see stagflation.
Yeah. Okay.
And I think disinflation is all very well and good, but you look where the baseline scenario is, and we're much higher than we were, 20 years ago, right? And I don't think that's going to come down. And as long the Fed have missed a trick, right? They've missed a trick. Raising interest rates has only hurt the guy on the street. It hasn't hurt, it hasn't hurt the wealth effect for the people who have lots of money. And what they should have been doing is extracting liquidity from the system instead of raising interest rates as high. And that would have been fairer for everybody. But
100% agree.
as we're seeing now, asset prices across markets, across all asset categories, are supported because of the excess liquidity in the system. And the Fed are now talking about, slowing the pace of QT, potentially coming to an end in the not too distant future. That's going to support asset prices. And I don't see how inflation can move lower on the back of that. Commodity prices are going up. So input prices are going up. So I can't see that we're going to have disinflation or deflation.
All right. Great answer. Thank you. I feel the same way.
Yeah. So here's what we're looking at. We run two main strategies. One is a global macro strategy, and the other primarily is what we do. Our bread and butter is long short equity. So we're looking at, and I think I spoke about this last time I was on, how I want to be short things that are linked to interest rates, because I don't think interest rates are coming down anywhere near as quick or as much as people might like. I think because of the inflation that's embedded in the system now, that's just not going to happen. So we like to be short things that are sensitive to interest rates, and we like to be long of things that are linked to what we call inflation trades. So, we think that energy prices are going higher, right? So Consol Energy, it's a coal company. Carpenter Technology, you know, that's a specialty metals and minerals company. We like these sorts of trades because, you know, inflation is not going away anytime soon. We've obviously been long gold and mining stocks for a while. Here's a couple of them that we've had in our portfolios. Uranium, another driver of inflation. You know, we think that uranium prices are going higher and energy prices are going higher. Oil, we've been looking at oil stocks. I've been banging on about this for the last 3 months now. I think there's going to be a huge rotation out of things like technology, telecoms, some of the other tech sectors. We've been short a whole bunch of solar plays, and we've been long of oil stocks. So we really like that sector and that switch, and we think I'll come on to something in a few seconds, and I'm not too far away from the end of the presentation now, but we do think that this trade will take time to play out, and there's going to be pullbacks along the way. As I said, with inflation, it's a multi-year, potentially decade plus type of trade, and timeframes are important. You have to remember that. You guys, I know, are very much focused on, you know, some of the shorter term trades in FX markets. And, you know, I started out life as actually an FX trader back at Lehman Brothers in the 80s. So I'm on board with that. But for what we do currently here, you know, we look on a longer time frame.
Yeah.
So Bitcoin, you know, I really don't like Bitcoin all that much, but you have to trade what you see in front of you. And what we see is inflation, and we see asset prices supported by too much liquidity, which means things will get driven higher. So we've been long of, you know, Bitcoin mining stocks. We've been long of, you know, Coinbase, which is obviously an exchange for cryptos. So those are the sorts of things that we've been looking at. I specifically haven't put anything in the presentation about our short positions, because in our opportunistic long short fund, we're dollar neutral, which means for every dollar of longs we have to have a dollar of shorts. And we don't usually like talking about the short sides of our trades for a number of reasons. Number one is, you know, for compliance purposes. Number two, you know, the hedge funds that I work with, you know, pay, you know, fairly hefty premium for this sort of advice. And the third thing is, we don't get caught out in any short squeezes. So because the positions we hold are fairly big, our typical ticket size is, you know, between $5 and $10 million. So I'll just finish off with this slide, and this is going to address some of your questions, maybe, Blake. I'm not selling anything, and this is not investment advice, and please don't construe it as such. I'm semi-retired. I only work with a handful of clients, and I don't need to sell anything online. So take that for what it is. You don't survive in this business for very long unless you have what I call depth. And by that, I mean diversification. So the point I will make about this is that no single position in my portfolio is more than 5% of the portfolio. And diversification can save you from a myriad of sins. It saves you from getting too big on a position. It saves you from, you know, doing something stupid like doubling down. You have to have diversification. If a single position is too big and it goes wrong and it wipes out your whole month or your whole quarter or your whole year, or maybe you know, if you're very, very concentrated, you know, your whole portfolio, don't get into that position. You know, you want to be in the business a long time, whether you're doing it as a career or whether you're doing it just to manage your own portfolio. Einstein, so Einstein, you know, is known for his various theories, his his quantum theory of light, his special theory of relativity, his general theory of relativity, blah 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 blah. But one thing that Einstein said is time is an illusion, and what I mean by that is time frames are relevant to the individual. So your viewers, your subscribers, they might have a very short-term time frame. They might be trading off a 5-minute chart or an hourly chart or a 4-hour chart. everybody's time frame is relevant to them. We operate on a much longer time frame. We look at macro themes that are generally going to be in place for many months or many years in some cases. In our portfolios, my typical time frame for a trade is, probably 3 or 4 weeks at the shortest. We will have a fairly high turnover of our long short book. But time frames are important. So understand your time frames. Don't expect, you're going to make 20% on a position in a few days. If the market allows you, great, but be patient and understand what your time frame is. Probability. Okay, this is important. I'm ranked number 1 in the world for what I do, or there or thereabouts, quarter after quarter. But I'm only ever right probably 60 to 65% of the time, which means that 1 out of 3 trades that I put on, I'm wrong. And I think people starting out in the business think they have to be right all the time, or they want to prove that they're right on all the time. And I remember when I first came in the business back in the 80s, I thought I was super smart, and I wanted to show everybody that I was working for at the banks, I'm the smartest guy on the trading floor. I wanted to be right 100% of the time. It doesn't work like that. And you need to understand that, and you need to take that in and absorb it. You're never going to be right 100% of the time. And even if you're right 60% of the time, you can still make a lot of money. It's all about managing your risk, letting your winners run, cutting your losers quickly or relatively quickly, and understanding that you're not going to be right. And that's just the way of the world. And then I put to fit with the acronym, I've put T for thoroughness, but what I really mean here is process, but I've already got a P in probability. So so thoroughness. I know what my investment process is. I know what my style is. I know what my process of understanding the macro environment is, drilling down from that in terms of doing some screening, coming up with themes that I want to follow and implement in the portfolio. And you have to do that time and time again. And this is coming back to the probability. Knowing that I'm only right 60 to 65% of the times, when I'm wrong, I just kick that trade into touch. I just kick it into touch, get it out of the portfolio. It's not going to help you. Don't double down, just get rid of it. Take the loss, move on. Thoroughness. You've got a process. Go back to your process and go through it again and find another idea. Okay, it's very, very simple. It's investing is a very boring business. I mean, I have a lot of fun, to be honest, but it is a very boring business in respect to the fact you have to have a process and follow that process. And then finally, humility, understanding all of the above, right? If you understand all of the above, know that you're going to be wrong. You're only going to be right 60% of the time, even if you're very good. And just accept the fact that the market will give you what it wants to give you. The market's not beholden to you. If you're wrong, you're wrong. Just get out. Say, oh, you know what? I got it wrong. Get out. Try and run your winners as long as you can. And funnily enough, I find that harder than I do cutting risk. Once something's not working for me, I boot it out of the portfolio.
I 100% agree with that.
But letting things run, like the copper trade, right? And maybe because I was on holiday, we got out, we'd made 16, 17% in the space of 6 weeks, but we got out. And what we should have done is we probably should have taken some of it off and let the rest run. So it's all a process. Anyway, that's probably what I wanted to say to you today. I hope it's been informative and enjoyable for you. That's where you can reach me. I'm not looking for billions of people to follow me. I'm not selling anything. I don't have a website, but I'm happy to see people on Twitter and interact. I know you guys do a great job. And one last thing before I go, Blake. I know you have a mentoring program where you are helping people in the community. Because I love what you guys do, and I'm very proud of what you do to help the wider community. I'd like to offer free of charge, and you do it how you want. I will offer myself 1 hour per quarter, so just once a quarter, for one of your subscribers to do an hour session with me if they want to do that.
You know, Dale, that's a really, really nice, that's really generous of you. How about I'll circle back with you privately and we can talk through the details. Dale, I was really impressed with your presentation. Now, like I said, from earlier, last time or the very first time you were here, I remember being able to sit through a bit of your presentation. I want to say really great information. I wanted just to add, comment on a couple of things you just said, though. The talk about the probabilities. I mean, you can actually even look at our 7 years of keeping tabs on our whole entire team, not me, not anybody in particular, our whole entire team. We're right on 52% of our ideas, but we're still up substantially over the course of 7 years. So that just shows you you don't have to be right all the time, and it goes to what Dale was saying. And also, when you said diversification, I want to ask you this, Dale, really quick. We're in a market where so many assets are just moving together in unison. It's like one market. It doesn't matter if you're trading notes or the dollar or precious metals or equities. They all move together. Has that posed a challenge for you from a diversification standpoint over in recent years?
No, it generally doesn't. What you tend to find is in periods of market stress, periods of market stress, correlations 10 to 1. So diversification then is kind of a moot point because everything moves together when things are crashing. What you then have to do is be able to identify that you're in that sort of an environment and have some kind of cheap protection somewhere in the portfolio. I'm talking about the macro book now. Not so much. It doesn't matter so much in the long short book because for every trade that we have on, every long position we have on, we have a short position against it, and we typically run 25, 30 positions in the portfolio. So we're never really, we don't have any underlying market exposure because we're dollar neutral. And we're sufficiently diversified across, different sectors and so on. So, but yeah, I get you. I get what you're trying to get at here. At the moment, things are all moving up together, and that is an unusual environment, but that's just a function of the fact that the Fed have, created a monster.
They have.
At some point, it may well implode. I think you'll get some warning of that because volatility will start to pick up, and then when vol starts to pick up, that's when you probably want to do things like, scaling back your position sizes, top slice the portfolio, maybe buy some out of the money protection, and maybe take some positions off entirely, especially the more volatile positions.
I think we have a wild several years in front of us, Dale, and I'm sure you'd probably agree with that based on your experience and what we've seen in recent decades. Or over the last several decades and what we've seen in recent years, we're gonna have to really strap on our seatbelts soon.
Mine's been on for a while.
All right. Well, I'll be sitting right next to you, my friend. Dale, I want to say really, really nice hearing you, and I'm going to circle back with you regarding your very generous offer because I think you are really a blessing to have here. So thank you so much for your time today.
My pleasure. As I've said to you guys in the past, I think you do a fantastic job and keep up the good work. I think that the people in the community that work with you, are benefiting greatly from what you're doing.
Thank you, sir. Really appreciate you. All right. Well, Dale, like I said, I'm gonna circle back with you personally. Thanks again for your time today. It's been wonderful, and I know you should just, if you haven't had a chance to read some of the comments that have been coming through this chat, people are just very, very thankful to have you here. So, and I am too, as well.
You're more than welcome.
All right. Well, Dale, have a great one. Everybody, thank you so much for being here today. Remember, unemployment claims have been moving the markets the last couple of weeks. That's going to be highlighted tomorrow. So make sure you're around for that. We'll be covering that, as well. And then, tomorrow we'll have a boatload of PMIs coming through most of the world. So you guys hang on to your seats and buckle up, folks. It's going to be a ride. Thank you, Dale. Thanks everybody for coming in today, and we'll see you tomorrow on Face. Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.